Gold has protected wealth for thousands of years. It survived inflation, financial crises, and collapsing currencies. And unlike a company, it can't go bankrupt. So, should gold be part of the investment fund you're building for your child? Maybe. But once we compare gold's historical returns with stocks and other investments, the answer becomes more complicated. And before we begin, this video is for general education and entertainment, and it's not personal financial advice. Every family's circumstances are different, so consider speaking with a qualified financial professional before making investment decisions. So let's start by asking why people buy gold. Gold is usually purchased for protection rather than growth. It doesn't depend on one government, company, or currency. Investors often turn to it when they're worried about inflation, war, banking problems, or even falling stock markets. And gold has maintained its value across an extraordinary amount of history. But maintaining wealth and building wealth aren't necessarily the same thing. If you're investing for a child, you may have 10, 15, or even 18 years before the money is needed. That long time horizon gives you the ability to own assets that grow, even if their prices fluctuate along the way. So the important question isn't, is gold valuable? It clearly is. The question is gold the best asset for long term growth? Gold's historical return. According to the UBS Global Investment Returns Yearbook, the inflation adjusted price of gold in US dollars increased approximately fivefold between 1900 and 2025. That sounds impressive until you convert it into an annual return. Over those 126 years, gold produced a real return of approximately 1.3% per year. That means gold increased purchasing power, but fairly slowly. The results improved significantly after the gold linked Bretton Woods monetary system ended. Since the early 1970s, gold's inflation adjusted return has been closer to 4.7% annually in US dollars. But this illustrates an important problem with return comparisons. The starting date matters enormously. Begin near a low point for gold, and its performance can be incredible. Begin near a major gold peak, and an investor may wait years or even decades for a meaningful return. Gold's price rose dramatically during the 1970s, for example, before entering a long period of disappointing performance. So gold has protected purchasing power over extremely long periods, but it hasn't delivered that protection consistently. Gold versus stocks. Now compare that with stocks. Stocks represent ownership in productive businesses. Those businesses sell products, earn profits, develop technology, and may distribute dividends. As economies and corporate earnings grow, shareholders can participate in that growth. Gold doesn't produce revenue. It doesn't pay interest or generate profits. Your return depends primarily on someone eventually paying more for the same metal. Using the United States as one long running example, equities produced an inflation adjusted return of approximately 6.6% per year between 1900 and 2025. Compare that with gold's 1.3% real return over the same broad period. The difference between 1.3% and 6.6% may not sound enormous in 1 year, but compounded over 18 years, it becomes substantial. $10,000 growing at 1.3% above inflation would approximately reach $12,600 in today's purchasing power. At 6.6%, it would grow to roughly $31,600. Past returns don't necessarily guarantee future results, and one country's history isn't the entire world. But the comparison demonstrates why productive assets have historically been more powerful wealth builders. But gold can still help. If stocks have historically produced higher long term returns, why own gold at all? Diversification. Gold doesn't always move in the same direction as stocks and bonds. During certain financial crises or periods of severe uncertainty, it may hold its value or even rise while other assets struggle. That can reduce the overall volatility of a portfolio and give an investor something stable to rebalance from when markets fall. But gold isn't a perfect crisis or inflation hedge. In other words, high inflation doesn't automatically mean gold will rise. Gold can help diversify a portfolio, but it shouldn't be treated like a machine that perfectly tracks inflation. So, the final question: should it be in your child's fund? For a child with a long investment horizon, I would generally view diversified equities as the portfolio's true growth engine. A broad global stock fund owns businesses across different countries and industries. It provides diversification while allowing the portfolio to participate in global economic growth. Bonds or cash can become more important as the date when the money will be needed approaches. Gold is optional. A small allocation, perhaps 5%, could add another source of diversification, especially if it helps you remain invested when markets become frightening. But I wouldn't make gold the center of a child's investment fund. A large gold allocation could reduce the portfolio's long term growth potential, especially over a period when stocks perform well. And remember that gold miners aren't the same as gold itself. A gold mining company has management, operating costs, debt, political risks, and potential production problems. It may move differently from the price of physical gold. If your goal is direct gold exposure, a low cost fund backed by physical gold is generally a closer match than shares in mining companies. The verdict. So, should gold be part of your child's investment fund? It can be, but it doesn't have to be. Historically, gold has been useful for preserving purchasing power and diversifying the portfolio. But over the very long term, its real return has been much lower than the return from equities. For a child with many years ahead, I would prioritize diversified productive assets, keep costs low, invest consistently, and gradually reduce risk as the money's target date approaches. If you want gold, treat it as a supporting player, not the main character. Because the goal of a child's investment fund isn't to predict the next crisis or chase whichever asset recently performed best. It's to build a simple portfolio you can keep funding for years. If you're a Canadian dad trying to make smarter decisions about money, investing, and raising a family, subscribe to Canadian Finance Dad, and I'll see you in the next one.